Great. Well, yeah, here I am. Welcome and good morning to our little DeFi and Fintech panel here at Mainnet. I'm Konstantin Richter. I'm the CEO and founder of Blockdaemon. I have brought some fellow industry veterans from different areas in the space. Goal of today is we want to talk a little bit about institutions and DeFi. And this is obviously a very wide range in talking about what's possible, how is the current landscape of financial products shaping and changing, how institutions engage with crypto, what are the innovations in crypto that are potentially interesting to institutions, how does regulation play into this, what are the sort of flywheels inherent in these different models that attract institutions. And so we're going to try and keep it fairly light and simple, but talk about some stuff that you maybe don't hear normally when you have these type of panels. And so we're going to start with quick introductions. So you guys, get to do your spiel for 2 minutes each, and then we'll have an open conversation here. There'll be some room for questions in the end. And yeah, I'm excited to be here. Maybe just a quick word about Blockdaemon and why we're sponsoring this particular discussion. So we're an infrastructure provider, really pure tech. We run the physical nodes that allow for transactions to be submitted to the network. We also run nodes that earn yield for institutions. We're not a B2C company, we're a B2B2C company, which means that we work with companies that have customers and we provide the technology for them to participate in crypto. And so we're really a fairly ubiquitous, pure software play. And we work with a lot of different institutions, enabling their participation in the crypto networks. And so that's why I'm here today. And maybe we just go around. Sarah, do you want to say hello?
Sure. Hey, everyone. I'm Sarah Olsen. I lead corporate development for Onyx by JP Morgan. So I focus on strategic investments and partnerships in the blockchain space. Prior to this, I worked for Cameron and Tyler Winklevoss, leading corporate development for Gemini. And then prior to that, had some boring asset management jobs that we don't have to talk about.
Hi, I'm Jack O'Haller, and I'm the CEO of SKALE Labs. We are the core team behind the SKALE Network, which is an open source, peer-to-peer blockchain scalability platform or protocol. So I'm here representing the disruptive technology side of the industry today.
I wanted him to wear an eye patch, but he said no.
We couldn't find one. I would have worn it.
Great. It's so nice to meet you all and be on this panel with all of you. My name is Kantorovich. I lead institutional coverage at FalconX. FalconX is a one-stop shop for institutions looking to get trading, clearing, and credit in cryptocurrency and digital assets. Very excited to be here today.
Hello, I'm Jesus Rodriguez. I'm the CEO of IntoTheBlock. We're a platform that uses machine learning and data science to provide insight about crypto assets, and also have a second division that builds intelligent quantitative strategies in DeFi. So we get to see DeFi both from the informational side and the actionable side. I have had a long career in tech that include 10 years at Microsoft, building quant systems in Wall Street, and a couple of exits as an entrepreneur. So.
Great, yeah, great to be here. Ollie Harris, I lead the digital assets team in North America for Goldman Sachs. Think of us as like the one-stop shop for all things crypto and blockchain for the firm. That includes a mixture of crypto trading for cash-settled products and derivatives, investments. We're a proud investor in Blockdaemon, alongside thinking through like the rewiring of capital markets. So we're really looking at the permissionless space and the permission space, i.e. the enterprise blockchain side, and trying to bring those worlds together.
Great. And actually why, I'm going to put you on the spot just because it's always fun. Yep. Why don't you tell us what you think DeFi is?
DeFi, so for me, obviously, I know that it's decentralized finance, which is amazing. And I think personally, I'm super interested in the ability to look at the permissionless space where anyone can join networks and be an agent on a network, but also the ability to do that programmatically in a trustless fashion, which obviously is like super interesting. So that's my specific definition, and I'd keep it to like finance and separate it from like NFT land, Web3, and the other domains that are all in this sort of emerging decentralized world.
Yep. No, that sounds.
Is that all right?
Yeah, that sounds good. That sounds good. I'm always interested because DeFi obviously is one of those terms that encompasses a lot of potential stuff. I always imagine it as sort of like my checking account that I earn interest on, right? So I'm always thinking like if I call my bank and they turn me down for a loan, that's my experience in banking. And so and DeFi is sort of instead of talking to an individual, I'm talking to a smart contract, right?
Yep.
Like so that's sort of the sort of general idea, and it comes with all the sort of problems that you potentially have in software. Talking to a smart contract, the smart contract might have a bug. It might sit on a system that is difficult to verify ownership and things like that. But so I'm curious about. So you talked a little bit about connectors and things. What are the current challenges for institutions actually when it comes to crypto? Sarah, I was thinking of JP Morgan. And just sort of kind of thinking about like, you're obviously somebody who enjoys and thinks a lot about crypto in an institution that obviously is bound by a lot of regulation. When you think about these things, what are the factors that make this complicated for an institution like yours?
Well, I think there are two factors, and I think there's sort of the good and the bad of it. The bad being, you think about what a financial institution, like a bank is, and they maintain ledgers and they act as a central clearing party. And now we have technology that can do that without the need of like a major institution. So the question is like, where does an institution like ours sort of fall within this tech stack? And so in that sense, it's it's a little bit protectionist, which is not a great approach to the space, but it's also trying to figure out like where can we strategically add value. On the flip side of that, in terms of what I would say like the good approach that banks take is being really thoughtful about KYC, AML, security. And so when you're thinking about a bank like JP Morgan or Goldman Sachs should participate in DeFi, without good identity solutions and KYC for on-chain, identifying wallets, bad security practices where you have a $600 million hack from a DeFi platform, that's really these are huge issues before a bank like JP Morgan can just sort of jump into the space. So, I think that some of the approach that we take could definitely use some improvement, but a lot of it, I think we can bring our expertise to say, like, how do we make this safe, reliable, legal, compliant, and that's where I think that we're going to add the most value.
Yeah, interesting. I was thinking about maybe you can describe a little bit the opportunity of DeFi, since you're kind of a little more ahead as a sort of more crypto native entity. Working in bringing banks to DeFi, like what are the commercial opportunities? What is the sort of, why is this so interesting? Why are people here trying to understand how institutions think about DeFi?
Yeah, so institutions are thinking about DeFi because of yield. There's no question about it. And I think the biggest thing is if you look at a money market account today, it's yielding maybe 0.5%. Institutions are trying to give their clients at least 2% returns, and some DeFi pools yield 900%. And so while that may not be sustainable year over year, it's definitely a number that is very difficult to look away from, and especially in a market today where bonds aren't yielding as significant as they were historically. And so I think for institutions, it's looking at how do I get LPs and stakeholders some level of return that I see asset managers currently providing. And so one way that institutions are doing so is in equity. So they are either doing private equity deals into infrastructure players like the folks on this panel today. They're investing into funds, whether these are hedge funds or venture funds who are investing into DeFi pools directly, or they're using a centralized party like FalconX to potentially buy wholesale the DeFi tokens, and so they can get some level of the upside relative to the growth of the underlying protocol. And so in that instance, to all the points that you mentioned, Sarah, you're not necessarily interacting with the pools, where, for example, KYC is going to be something that's very top of mind, but you still have some level of exposure to the upside of the protocol and that growth. And so I think at a high level, especially for something like finance, I think something that's actually really, really interesting specific to DeFi is also thinking about like what's finance and what isn't. To the point that you mentioned before today, if you are an employee at a bank, you can't buy cryptocurrency because the bank currently doesn't support spot. But you can buy NFTs because the bank sees NFTs as a piece of art. But you can also use NFTs to get leverage. So is it really art or is it finance? And so I think right now there's that gray space too around what you mentioned earlier, which is DeFi is a big label, and we like using labels in crypto. But how do you get yield across all of these different variables in the space, whether directly or indirectly?
I have a follow-up question for that, because like the crypto industry loves using the term sort of money market fund to talk about DeFi, but it's not really a money market fund. So they talk about sort of low yields and treasuries, and that's kind of how we think about a money market fund in terms of the traditional space. But then there's been times where you've had incredible yields, like both in sovereign debt or corporate debt, emerging market debt as well. So it's it's interesting that like we always kind of the crypto space is using the term money market fund, but like, do we think that's like the right term to be using, and should we be thinking about it as like a risk-free asset like money markets, the way we think about a money market fund for treasuries, or like have we been like kind of equivocating this term? Like we're just
That's
like
a good question.
Yeah.
I think it depends on, like today there are institutions that invest in very volatile assets outside just this term money market, whether it's foreign government bonds that are incredibly volatile, whether it's in Europe, South America, Asia. And so if you look at just the risk profile, like again, it goes back to this label, right? I think today, 100% agreed. I'm thinking more the money market funds that maybe a smaller SMB might be able to access relative in comparison to like a larger institution that has access to higher yielding money market accounts. But at the end of the day, you bring up a really good point, which is like there's a lot of risky assets that institutions, regulated entities can access today that in my head, are very relatable to the volatility you see in some crypto assets, whether it's DeFi or not.
Yeah, another element is just the role compliance plays in nomenclature. So because of these gray areas, people creating these terms and labels have to create them with compliance in mind. And if something is not a security, if something is a piece of a protocol that can be participating in a network and it's a token, it's a utility token, it actually can't have specific financial terms. So it's also like a little bit of legal gymnastics along with the desire to be accurate.
Yeah, no, that's interesting. Jesus, do you want to quickly give an example of a product in DeFi that actually attracts high yields? Like how do you guys, can you describe what you guys do?
Yeah, so to the point you were mentioning before that institutions are into DeFi for yields, I think that's a phenomenon of the current market conditions, but it's probably not sustainable. And there is also markets in the, particularly in emerging economies, that you can get super high yields, and they're very, very well-known trades on that. I think DeFi, because being inefficient, being completely asymmetric in terms of the opportunity, and there is a huge leverage trade in terms of stable coins in the market, there's massive yields that are being produced. So from an institutional standpoint, they're, let's say, the safest side of the DeFi spectrum. Nothing is risk-free in DeFi, like risk takes a different connotation. But there is a spectrum of protocols that are more battle-tested, like Curve, Aave, Compound, things like that. And there are just massive opportunities to earn like very decent yields. They're on your crypto holdings, stable coins or ETH, and remaining long on those assets, and also very good hedging mechanisms and actually fairly decent risk management policies that you can put in place that compared to many things that you can do in traditional capital markets.
Yeah, interesting. Ollie, is there a way you can describe a little bit, like since you're at Goldman, like the regulation is a big part in this, and like kind of what's the complexity look like? And Sarah touched on it, like there's obviously risks with smart contracts, there's bugs that get exploited. But like what are the concerns for an entity like yours when you look at any of these type of projects that make it hard for Goldman to engage?
I'll delineate sort of non-US and US institutions specifically, and I think given we are a US institution, there's a wide variety of regulations that we need to ensure that we meet, and as a result of that, one of them is we can't actually hold the underlying currently, which means
Why is that, by the way? Do you know what's the fear there?
I think it's more, it's not a Goldman Sachs thing, it's any US bank issue, and that means that as a result we can trade cash settled products and derivatives like the CME futures on regulated venues, but we can't currently obviously hold on our balance sheet Bitcoin or other tokens. which is one like key limit in terms of like things we want to do principally, but also things we'd want to do from in terms of anything principal to help clients. I think to delineate three issues, I say one is, I think to Sarah's point, the KYC, AML, I think, OFAC, there's a whole list of regulations we need to meet. And I think until we have decentralized identity or, permission pools like Aave, Arc, and Compound and others that are looking at this.
When you say decentralized identity, I just want to follow up. What do you mean?
Yeah, so you need the ability to embed identity into a token. And I've seen some interesting, not yet live ideas, but let's say, for example, if you could wrap identity through like a ZKP onto a Bitcoin, which would be great, because when we looked at that specific token, we would know like what's the provenance, what's the history, does this meet like OFAC, and we might have the ability to service that token, whether it's like custody or lending against it particularly, although if we're allowed to in the future, trade it principally. So decentralized identity is one. Obviously, there are products in the market today like Chainalysis and TRM that are doing a great job at like helping that. But if you don't know who you're facing on the other side on Aave, Compound, or others, that's obviously a showstopper currently. The second is, and I don't think this is brought up much, but actually just like the risk management of the protocol itself and ensuring it meets like capital market standards. So can you actually like front running the algorithm behind it? Like, do you have ways to ensure that these algos are actually fit for purpose? And then finally, I'd say systemic risk. And again, all those three problems are problems that we've already solved, I'd say, in traditional capital markets. And again, there are some great ideas working on this in DeFi. It's just going to take time until we see like widespread institutional adoption in DeFi.
Yeah.
Can I take a controversial point there?
Sure.
So at the risk that the regulators in the room get all upset and all that. So those points are valid, but the thing that I get really concerned about is when we try to solve those issues for a new type of platform like DeFi that is programmable and digital and decentralized using the same mechanisms that we have for a financial system that, other than some evolution on the digital side, hasn't really changed much in like 100 years. So when you think, for instance, about KYC and AML, so Oli mentioned a valid point. Yes, identity needs to be present, but it doesn't have to be identity in the traditional way. It could be used in CK techniques and zero knowledge proof or secure multi-party computations or things like that provide secure identity assertions without revealing the identity of the counterparty. But interestingly enough, here's a controversial point. Everything in DeFi is visible. So you have more data about what's happening in the market than in any other financial instrument in the market. So could you provide enough intelligence about something, let's say a compound market, enough intelligence of what's happening there, what type of wallets, liquidations, or things like that if it is enough for a regulator or for a financial institution to say, I'm comfortable with that? Like there hasn't been any hacks, there are no liquidations, the entities trading here trade within certain, almost like a credit score system for a specific market. And you can do that in DeFi, you cannot do it in any other traditional market. And in terms of the systemic, making sure that the protocols are meet financial market standards, well, these are smart contracts. So you can actually do formal verification on all those things and do stress tests that are programmable and verifiable by anyone.
But yeah, I'm curious, Jake, tell us a little bit about how you do this at scale, and how do you guys, how does your roadmap look? Even when you think about, do you think about institutions? Like what does that look like?
So I think when you said you're in the business of B to B to C, I think what we see a lot in crypto is G to G, geek to geek. Okay? And what we're trying to do is build open source protocols that, I think there's a lot of square pegging. You're trying to push these square pegs into round holes. Like at the end of the day, these are smart contracts. These are open, decentralized networks. They let money flow freely. Now, there's things you can do off chain to try to help the ingress of money and the outflow of money, and you have Chainalysis and different tools for KYC, AML. But at the end of the day, these are open protocols, and our desire is not to just have people who know how to manage a ledger device, people who know how to read a smart contract audit. We want institutions to be able to participate in these networks and help people who are currently not getting access, because there is this knowledge gap and this moat for people that know how to use a ledger and know how to, and institutions and funds that know how to do that. So, I mean, what Blockdaemon's doing, I get pretty excited about, because, for example, they can run nodes in the SKALE network, work with institutions that then can stake tokens in the network and get returned by participating actually with a token. And it's not just betting with a financial security or owning shares. We're actually participating in networks. And I think that's the goal, is how do we get more people participating upstream?
Yeah, I'm always amazed with, because we're sort of a crypto native company, and I often get stuck in arguments that I'm really excited about companies like Robinhood and PayPal and all this sort of kind of next generation of digital financial services provider coming into the space, because there is this sort of thought in crypto that we have to destroy the current system for this to work. And then there's the sort of side of, as you said, which is kind of sort of geek to geek. But it's really like, how do you really help the people and bring financial revolution to a much larger audience that actually, for example, isn't tech savvy? And how do you do that? And how do you actually onboard large, actually, pools of capital into regulated ways to participate in DeFi? And it's such a complicated discussion, because obviously there are a lot of different stakeholders in it. But I'm curious, like, what's the maybe Sarah, I don't know if you have those data points ready, but I'm curious, like, how does how big actually is JP Morgan in terms of, do you know how many people bank with you guys? Like, what would an opportunity look like in your perfect world? Imagine JP Morgan would be on DeFi. Like, what would that do? I'm just kind of curious what the scale is that we're talking about.
Wow, this is a question that could get me in trouble, probably.
That's probably true.
Yeah, it's no.
Yeah.
I mean, I think the opportunity for a bank like JP Morgan in the DeFi space is massive, right? And back to the earlier point, again, we have 250,000 employees globally. We service some of the largest institutions, both corporate clients and other banks globally. We have an incredible network, and again, we specialize in things like KYC, AML, security. Maybe not like from the sort of crypto security standpoint, but we're really stewards of the global financial system. Again, I think that where I think it's going to be really important is the right intersection of private and public infrastructure. And I'm a big believer personally that public infrastructure is really going to win out. Because if you take an open network where you allow anyone to participate in it, like, that's where the best ideas are going to come from. And don't get me wrong. I mean, like, Goldman has super smart people like Ollie, and JP Morgan has a great team of 100 people focusing on these issues. But we're not 6 billion people that have access to open networks. So I think what's going to be really important for JP Morgan and other banks to be successful in this space is, how do we appropriately tack onto public infrastructure and add our own expertise? Maybe that's through KYC, maybe that's through balance sheet capital, but again, it's really not trying to create our own sort of system or our own alternative. It's how do we appropriately support this system. And then lastly, I'll say too that it's to the point before, I think that the crypto market needs to be a lot more patient with the traditional market. And I have to remind myself too, when I'm working with employees internally, they're selling hundreds of different types of products across the platform to their clients. And then, I'll be speaking with, the world's largest retailers, or, folks that are making farming equipment. So for them to kind of understand the difference between like a MetaMask wallet and a BRD wallet, and a NFT that's printed on Flow versus Ethereum versus Solana, is just ridiculous. So like, I think that like, this sort of group of people needs to do a better job abstracting away some of these difficulties to make it more accessible.
Yeah, which is interesting. For all the talk about institutions getting into DeFi, we should remind ourselves that the whole DeFi space is a crypto-to-crypto play today. Like retail, like traditional fiat is not coming into DeFi yet. And then I don't think any individual protocol could simulate something like JP Morgan or Goldman going into it. But the entire space is a double-digit billion market cap. Individual protocols are a fraction of that. So the space has to grow quite a bit before it's ready for that type of volume.
Yeah, I also think that there's low-hanging fruit. There's two really low-hanging pieces of fruit where complexity can be abstracted away, and we have incredibly proven use cases. And one is just staking in protocols. And staking in protocols is very different than just aping into a DeFi pool, right? You're there for a longer period of time. There's a history with the protocol. There's a very fixed and clear set of return, and there's a clear set of just risks. That's one, and there's no complexity. You go through a Blockdaemon, right? And the other one is just lending and borrowing. So just Compound and Aave, like they're just really clear, and you're not going to get 900% return, but you're going to make 3.5% return just going through a smart contract compared to your 0.5% at your bank account for a savings account, effectively.
The problem in those things is, which is an area that we spend a lot of time working on, is that all those protocols like lending, they do have systemic risk, right? Like particularly in lending, there are liquidations, right? Like all the time. So if you're a retail investor with no knowledge of DeFi, and you're lending to a specific compound market, and there is volatility, and then part of your position gets liquidated, I mean, that's hard. Right, and you need to, and it's not tricky to monitor. Super tricky to monitor those things and to know how to manage positions. So those things have to be mitigated or abstracted away in a way that could be digested by a normal person. That liquidation seems like science fiction.
Real quick, I'll build on this point because I think we're using institutions like very, very broadly, and like here we're talking about investment banks. Like that is a very, very, very unique group of institutions. Like there is a wide range of multi-billion-dollar asset managers around the world who are actively engaged in crypto. There's $82 billion of total value locked in DeFi. That is not all retail. It couldn't possibly be retail capital. So there are large institutional investors that are active in these spaces today that we engage with on a day-to-day. And you mentioned staking, right? So you can, as I mentioned, you can buy wholesale liquidity and stake it on protocols and engage in the ecosystem in a way that may not be lending and borrowing and putting yourself up to smart contract risk. You can also lend out dollars or stable coins to centralized organizations that engage with DeFi in a safe way. You can work with protocols by lending them US dollars and USDC in a way that is not necessarily on the protocol. So there's a really large middle ground. And while I agree, like with the investment banks, we definitely have to be patient. Like we are getting, like 50% of our flows today is traditional finance. And that is a lot relative to crypto native. And so I actually think
one thing though that I do have to say about that though is when you're talking about asset management firms, you're talking about alternative asset management firms, and you're talking about firms where you have to be a qualified investor or accredited investor to be able to invest in those. And I think what's going to be really, really important, again, one, they have more flexibility in terms of their mandate. So we have not seen asset management in terms of long only kind of mutual fund for the people, sort of Vanguard type solutions, which is really important. And then and the other thing too is I think, again, when we think about sort of democratizing finance, like there are a lot of hedge fund managers out there that are making a lot of money through like participating in DeFi, but like again, I don't think that that's the actualized dream. And the question I think is, does that have to flow through a commercial bank like JP Morgan? Does that flow through a central bank that's now doing commercial bank activities? But I do think we should be delineating between sort of like the hedge fund private equity market and the banking system.
Sure, but you can even talk about endowments and foundations that are active in this space. So I think like define institution first, and like keep investment banking out of it, because investment banks don't have the custody where they can hold crypto.
Yeah, and that was
today.
actually going to be my next point, which is I'd delineate two things. One is actually custody has been the foundation of getting institutions more broadly, but specifically like family offices, alternatives, as like at the vanguard of institutional adoption. And I think that's where, obviously from our side, we've been an active investor, we're an investor in BitGo, and I think the custodians have done a great job at education and helping get institutions in, whether they are family offices or macro-focused hedge funds. And I think what excites us about Blockdaemon, and this kind of correlates with our client conversations, is like earlier in the year, it's all about custody, education, Bitcoin, learning about Ethereum, and now it's actually like quite nuanced conversations around DeFi, yield, stable coins, and the transition to staking. And I think the power of custody and Blockdaemon, where you can have staking as a service powered with an execution and custody offering, I think is going to be like truly game changing for institutions across the spectrum.
And is custody, I'm just actually curious about that. Like that description is interesting. So that's really the main difference. As an investment bank, you just never can hold custody of these assets?
Yeah, so as a US bank, we can't hold them principally, but I'd look at Bank of New York Mellon, like they're an investor in Fireblocks, they're building out their own digital custody offering. You know, it is possible to custody client assets if you have the right approvals. And I think there's been a lot of talk around, you know, crypto prime brokerage and custody and agency execution. And like, you know, both of us on this panel, it's public that we've had like RFIs and RFPs out. So I think ultimately over time, I think you will see the investment banks offering custody, you know, TBD on timelines. And I think that's because, to your point, the clients, you know, there are clients like hedge funds, corporates, real money, you name it. And we want to meet client needs.
Interesting. And then Aya, what's the current growth rate you guys see on your products? Like, how's the institutional adoption looking?
It looks great. So I'm trying to be the optimistic voice here on this panel. It looks really good.
Yeah.
Well, I can't disclose growth rate today. I think what is public is we've seen like over 100% growth year over year, and a lot of that is specifically due to really the shift in paradigm around the customers that we've been facing. We used to be, I think the whole industry can say this, very crypto native. We're seeing crypto venture funds, hedge funds, prop shops, OTC desks, exchanges, looking for liquidity needs. These are folks with large treasuries. It's pretty impressive to see that, you know, crypto funds that started off with 100 million, 200 million in AUM now have over $1 billion in assets under management. And so even the growth of crypto natives has gotten much more institutional, you could say. And then the more institutional folks, which you delineated, is like asset managers, prop shops, traditional venture funds making their first investment into token deals that are equity, into like large retail-facing institutions as well, like the PayPals and the Revoluts that have publicly disclosed they're entering the space. So it's pretty exciting. I think, you know, to your point, like for the folks who maybe, you know, don't have like the custody needs that a bank would, a regulated bank would, that can explore all the custodians. You mentioned BitGo, as well as a number of others. You know, I think right now we're seeing a lot of engagement in that space.
And just one data point for everybody. So I started working on SKALE in 2017 and have seen this massive growth curve. People thought staking would be this small market with, you know, people plugging computers into their grandma's and their mom's basements, and you know. The reality is there's $150 billion staked into proof of stake networks right now. And that would not be possible without institutional money. Okay, so institutions are coming in. It's not just retail people. And the people running these servers are not just individuals who are anarchists. These are businesses that are giving big money access to proof of stake networks. So, and you're obviously on the front lines of that.
Yeah, it's true. Yeah, so I want to make sure anything else you guys want to say. I want to leave a couple of minutes for questions, also for the audience, in case there are any. Anything you want to get off your chest when we talk about DeFi? I'm curious, what's next for you, Jesus, with IntoTheBlock?
Well, I mean, we have a front row seat to at least see how crypto institutions are playing DeFi. We have had like 150x increase in allocations to DeFi quant strategies in just 8 months. And it's very humbling to see how knowledgeable our customers are about this space. Like almost every week I get surprised by the ideas they come up with and how much they understand the space and new protocols, how smart they're getting into this. So in the face of uncertainty with areas like regulation and things like that, philosophically I tend to always go for the smartest tech play, and I think DeFi is as disruptive as it comes in terms of technology, and there is a lot of value being created, so I think it's going to win in the long term.
Great. Awesome. Well, I want to make sure we have some time for questions. I don't know if anyone here in the audience is interested to ask a question. Yeah, there's some mics. There you go.
So thank you. This has been fantastic. One of the best panels I've been to. So question, adoption happens not from the top down. Adoption happens from the ground up. Let's talk a little bit about the generational shift which crypto does represent, and how does that affect institutions? How does that affect massive international banks? And how does that affect the fact, like there is generational shift, and it's also global and borderless. And so
I gotta take this
happened?
one.
Sure. Yeah.
Yeah, I was chatting internally with a colleague, and he was like, "Oh, I don't know if I buy this," and I was like, "I don't care if you buy this, but go to your 10-year-old, and if they don't get it, we have a problem." So like it's really, you know, again, I look around this room, and like I don't want to say that we're all like obsolete, but we really got to be, we really have to be looking towards, you know, like the truly like the next generation, because how they think about value and how they think about value, identity, you know, it's just so different than all of us. And so it's everything from somebody wanting to make sure that their wardrobe for their avatar is as good as their wardrobe for themselves, to how they think about their educational experience in terms of how they think about money. But again, you know, I talk with my colleagues and they say, you know, I don't believe this is a thing. And I'm like, I do not care what you think. I care what your kids think. I want to know what they're buying. I want to know how they're spending their time. But like, if we're building sort of for ourselves, like we are doing this wrong.
It's like cell phones and Twitter and Facebook, you know, they weren't ever going to grow.
Yeah. Yeah.
Yeah, or even people keep asking about like mobile apps, and you know, like, oh, okay, this is all going to go through mobile apps, and you're like chuckling, and you're like, no, like this is going to like, you know, we're going to have brain chips, like we're going to have other ways of sort of interacting, like biometrics is getting better, and so everybody always wants to point, like look backwards to, you know, sort of analog, you know, examples, and it's just not the way of the future. And so, you know, I think that, you know, I think it's, again, you know, institutions get a lot right in terms of thinking about the responsibility of safeguarding value. But when we think about what value is, we really have to be looking towards younger people for that.
Yeah, the only thing I'd add is even if you look at some of the retail-facing names and the market caps around those tokens, like some of the best performers this year have been retail names. So if you look at Dogecoin, Cardano, Chainlink, and a lot of that is because there's been a shift in money from millennials to a younger crowd, and you're seeing that, you know, whether you want to talk about GameStop or not, but you know, this is significant size, and it's enough to move markets, and so I'm sure, like on the investment banking side, you know, it's definitely a conversation, and then retail moves market in crypto every day, which is why it's really exciting to see it trade 24/7 on weekends when traditional markets are closed.
Yeah. Okay, final question.
Hi.
Over there? Yeah.
So my question is more about validators. And so for Goldman, JP Morgan, and Blockdaemon, we focus a lot about KYC in terms of who you're facing on the other side of a transaction. But what hurdles do you see right now in terms of KYC, AML, in operating a validator? And then kind of a small follow-up to that, the hurdles to entry for validators now. You know, so having to get grants and needing something like $20 million to break even on a validator. Just your thoughts on that for the retail world versus institutions.
Sure. Yeah, I'll take that one because obviously we manage a lot of validators. I think, I mean, for us, and we're kind of, I mean, our position is, I mean, we care a lot about decentralized networks. We want a lot of different people to be able to run validators. So we do have concerns with how current interpretations of rules can jeopardize integrity of networks. As entities, as an institutional entity ourselves, we're actually able to KYC the tokens that sit on our validators, and we're actually able to fulfill regulatory demands if we needed to, which is, you know, we publish financial audited accounts, we have compliance officers on staff. We can handle the operational overhead of actually, you know, enabling a regulated function on validators. Not that we believe that that's the best way to do it, but as an institutional provider, that's something we can offer. And so my view, though, is that ideally you have a wide network of validators, but I think there's room for an institutional validator, for example, where every token that's on it is KYC-able, right? Where you can say, okay, here's a validator that actually, where we know where every token comes from, for example, and that's how an institution can participate. But what you can't do, for example, in that instance, is pool different tokens from different stakers onto each other, right? And so you have to really delineate between the different, where they come from. And I think that's one way how we think about it, is in order to ensure that institutions have a sort of a safe pathway onto these respective protocols and earning stake, is by offering them bespoke validators that only they can access, for example. And that creates other network risks, but we think that 10% of validators should represent that, for example. That's one way to think of it. We're back out of time. And so thank you so much for coming. Thank you, everyone. This was great. And yeah, we'll be around for questions. And, thank you.